Hello, everyone. Why? I'm going to give you 4 reasons why you need to worry about increased inflation. Why do you need to worry? Why is it a big deal? After all, what is inflation? Inflation is when the amount of money that you spend for the same item now needs to be increased in order for you to buy this item. Simple as that. Why is this a big deal? It is a big deal in the stock market because there's an inverse relationship between stock valuation and rates. And when we have lots of inflation, the way we cool that inflation is by raising rates. What? Exactly. You raise the rates, so everything is more expensive. You can't borrow as much, you can't do as much. Therefore, it is better, it is cheaper, and it costs more money. What are the 4 reasons? What are the 4 reasons that you need to know as an investor so that you do not get flat footed? You don't get caught flat footed because it's a basic of valuation. The valuation of the stock is extremely important. So, how do I deal with it? It's simple and it's complicated, but basically, let me give you the 4 reasons. The first reason why inflation is underestimated. The number that they come up with, which is a CPI, is basically a number that the Fed looks like that is computed by the Bureau of Labor Statistics. They take a basket of item and they get a price for it. So I know the number. Well, you know a number. You know a number as the way they're calculating. If we were to use the numbers that we calculated in 1980, the way it was calculated in 1980, you would find out very quickly that we are not at 2.6 or 3.3 if you look at core inflation. It's probably more than double that. There's a website that follows these things. So the actual rate of inflation is much higher. Maybe that's the reason why Trump got elected, because a bunch of people are pissed off about inflation. Things are costing more and more money. Maybe they're onto something. Maybe they realize that, hey, things do cost more money. Now, the reason why you need to worry about it is because, first of all, as a talking, walking human being, you also want to see how things are costing. And obviously, things are costing more and more money. Therefore, it's impacting you in your pocketbook. But as an investor, you need to realize that the Fed is data dependent. It doesn't really matter what the real number is, the real inflation, what is that number? The point is that there is a real number written on a piece of paper published by the BLS. And that is what the Fed follows. That is what they're looking at. That is what the market then decides whether or not we should be buying or selling, believe it or not. Why? Because if the number is too high, then the Fed will raise rates, or at least will slow the decrease in rates. And that is a problem. Because even though we're not dealing with reality, we are dealing with the reality of the number. And the reality of the number is what is used by investors to decide what's going to happen. And look at what happened after Trump got elected. Wow. We went up 30%, almost 40% on some of the stocks, including Tesla, which I'm following, by the way. Uh, but then the Fed talked about, when I mean the Fed, I'm talking about the Jerome Powell said, you know what, the economy is doing pretty well. Maybe I'm not going to be such a hurry to lower rates. Bada bing, bada boom, that's it. That was it. The market said that's it. He's not going to lower the rates. Rates are still going to go high. And the market vomited all over you. The market went down. So it does have an impact. That impact is important. Now, does this mean that they're going to stop lowering the rates? Probably not, right? Because they're not looking at the real number. They're looking at the CPI number, and it is slightly higher but it is under control. The last thing you want them to do is say, you know what, I am not going to raise rates anymore, right? I'm going to go the other way. I am going to lower the rates. You want them to do that, right? You want them to lower the rates because the more the Fed lower the rates, the more stocks go up. Why? It's a matter of finance. I mean, there's an inverse relationship between value and rates. Value and rates. As simple as that. You could calculate any day of the week. Trust me on that. Now, does it mean now that we don't have a problem? Well, and that comes to reason number two. The reason number two is, has the Fed changed its views? Well, you mentioned last week that, I don't know, maybe we're not going to be in such a hurry to reduce rates or something to that effect. And the market gets scared. But have they changed their views? I don't think so. I mean, rates are on their way down. It looks like we have things under control. So there's no reason for them to raise rates. We don't have an inflation problem anymore, at least on paper. Okay. Plus, there is the fact that, Trump is hot on their trail. Trump basically does not particularly like this guy. Trump wants a change. Trump is not going to get that change, but Trump wants it. So I think when the guy wants to keep his job, the guy wants to be consistent. So there is no real reason to change your mind. Because if you do change your mind, if he decides now, you know what, I think that I'm going to stop lowering rates, then he's going to send the signal to the market that in fact we do have an inflation problem. And then the market is going to take a bigger dump and be more afraid that we're going to have further rate cuts. No, you said you were going to lower the rates with inflation under control. Inflation has been coming down, therefore it is under control. Therefore, you have to keep lowering the rates. Reason number three why you need to worry. You need to worry about inflation, which is going to lead to increase interest rates, is that since the past 2 years, the interest coverage of corporations have steadily dropped from 9 times all the way to 7 for investment grade. Don't worry about too much about the number. All you need to know is because of the increased cost of borrowing, the rates, the ability for them to cover their debt is going down because of high interest rates. So, problem is that if you keep lowering the rates, then you're going to improve the condition of the small companies. If I look at the numbers for the small companies, it used to be 5 and now it's down to 3.5. So they covered 3.5 times their interest expense, which is tight, right? Not assuming they're making the money to pay for it, right? Because rates are higher, but then you have to make money. So the longer you keep those rates up, the more it hurts the small caps. And what you're going to delay this rotation trade that we've been waiting for, where the small the small companies finally get their dues in terms of valuation, and the markets start to recognize them instead of keep recognizing the Magnificent Seven. Now, if you look at the Russell 2000, the P ratio, and if you look at some of the companies that I have on my Patreon channel, look at the commentary. I'm following GCT, Miller Industry, all these companies. They are not being afforded a very good valuation because everyone is focused on Nvidia and focused on Tesla and focused on the Magnificent Seven. So that's the third reason Because of inflation will continue to impact small companies negatively, which will impact their P ratio, which will impact their ability to continue as a standing business. It's no good. And the reason number four, why you need to worry about our rates is the market simply does not like it. The market does not like high rates. As simple as that. They want lower rates. Why? Well, it's quite simple, actually, if you think about it. Let's say you have $1,000 and you want it to be invested. Where are you going to invest it? How about risk free for 5% as opposed to a bunch of risk for 20%, right? Then, if you have options where to invest your money, you will take that option. You will invest in high yielding instruments, which will compete against stock return, which will be the flow of fund is going to go towards CD rates or mortgages. I mean, bonds and things like that. That's a reason why. The fourth reason why it is not you need to worry if we have a high inflation that will impact the stock market. Do we have such a problem? Do we have an inflation problem? Whatever we had, it's gone. Why do I tell you? I'm talking about the numbers. I'm not talking about in real life. I'm talking about look at the CPI numbers. They are on their way down. They are under control. Okay. And keep in mind that this inflation that we created was not a typical type of inflation. It wasn't created because there was problem in the economy. It was created because of COVID, and we were not allowed to spend any money. So we got this huge built up of money that got released when we went out in the streets and we started buying a bunch of crazy things. So my final point is this: four reasons why you need to worry about high rates, about inflation. One, it is underestimated. In real life, we do have inflation, so it will impact your daily lives. Two, the Fed, the Fed may have changed its views. So you need to worry about it because then if the Fed changes views, that means that they're going to stop lowering rates. That is not good. Inflation will negatively impact small companies. That is not good for small caps, companies less than $2 billion, because they get disproportionately hit with the amount of interest rates. And four, the market just loves and needs lower rates. So keep that in mind, understand what's happening, learn, and then you make your investment decision. But understand what is really happening and what the market is thinking.